Now, in order to set the managers on the right path, I think it is important that shareholders play their important part. I have seen attended several AGMs. I think shareholders, minority or even HNIs, they were happy to receive maybe gift at the AGMs and happy to have a lunch or a food packet, okay, or maybe any gift which the company gives. But of late, we have seen that shareholders have started actively voicing their concerns on how the companies are run, okay, in a very large way. So Tata Motors, there's Eicher Motor, and I've seen that if you look at independent directors, for example, or even directors, for example, they're all associates in one way or the other, and in number of ways they are more compliant than probably they should be. Okay. And if you want to see the difference between the way company A, in terms of corporate finance decisions vis-a-vis company B, you should look at the board. The board of directors is truly independent and not related and not a yes man, then I think companies are run much better. Okay. At least there is a voice of dissent, because when a company is taking a wrong decision, there's someone to stop them. Now, recently, of course, this Z and Invesco, so all it means is that it is not a free for all kind of situation for managers. You can't really have it all. Okay. Now, active shareholders are having their say in how the companies are being run. Now, that was all about from a corporate finance perspective. And let's look at the second important area, an interesting one, which you all would be very excited about, of fintech. And I have seen this, terminology is not important. I think what is important probably is our understanding of it. I have seen the disruption. Technology was a disruptor, but to an extent, and what an extent, it's only a matter of guesses as of now. But let's understand, fintech is basically nothing but finance and technology put together. That they are called fintech. Any company that is using technology and finance as a deliverable it comes in the category of fintech. Now, FSB has defined, for example, I think this definition is vital from an understanding point of view. Technologically enabled innovation, important word, financial services, new business models, applications, processes or products, and material effect, financial markets and institutions. So fintech disruption is, you can see it's an innovative business model. They are creating products and processes, and they are affecting markets and structures in ways unimagined so far. We'll see during the course of next 10 to 15 minutes as to how this space has unfolded. I remember, I opened my account in my hometown when I was a student, then at the institute. So there was a physical presence, in the sense that I went to the bank. KYC was not there, but I think an introducer concept was there. Somebody introduced you, but being part of the institute or being a student, your ID card was good enough. Okay, saying you are a student, so you open a bank account. So traditionally, the way we looked at banking and finance, lending and borrowing, I've seen this progression from 1980s, mid 1980s, that how this transformation took place. So competitive advantage was that SBI is a large bank; it has branches all over all over India. So if you need to have an account, you can open an account and maybe access SBI from anywhere. Okay. That was a branch banking. Now, and their income was largely fund-based. Fund-based means that whatever is the difference between their borrowing and lending cost, that which you call a net interest margins, okay, that was their income, net of administrative and other overhead costs. Now today, wherever it was the need of the hour, in the sense that what you call asymmetric information, nobody has access today. For example, as investors, I still call it in the sense that while we say information is available everywhere, but I would say, how about a lot of noise also is there. Is the same information going across to everybody in the same way? Perhaps may or may not be. So frictions created a process of intermediation. Brokers were required. I mean, I've been part of that. As a student like you, I went first time to odd lot market in Ahmedabad. Odd lot market used to be like, earlier the physical share used to be in 100 lots of 100. So odd lot was 1 share, 5 share, 25 shares, 73 shares. Those were called odd lots. And there used to be like a mela like this. So where there'll be sellers and there'll be buyers. Okay. That was the first brush with my first brush with the process of auctioneering. Okay. The auctioneer used to be, the guy has rented out a space and he's saying 25 share of Tata Steel, SKF on sale. Market price was X, so you bid your price. Okay. Now those times from the auctions, you really find the price discovery. But basically, markets, you can't buy it from the market without going through the intermediary. Where do you go? How do you find? There's no market. So SEBI had registered members. So intermediation was part of the process. That intermediation has been killed by, or killed in the sense is that is basically made good by use of technology. Communication technology made it feasible to reach a large number of economies of scale. You want to serve 1 million customers for a bank, they need to probably hire more people. Technology made that possible, that economies of scale were that using technology you could service a lot many without actually incurring additional cost. Big data, when you say big data, it's a large soft information in the sense that you could collect. Today I find a bit you go to a department store or you go to any mall, shopping mall, everybody, you go to a restaurant, ask you your mobile phone number. Ask this question for what? I have bought the products. Go home. Okay. Give me cash memo and I'm done with. Everybody. So they are collecting the information, and that information is up for grabs or what you can call for sale. I'll come to that in the sense that there are concern areas. Then the fintech basically is the process of disintermediation. Wherever the intermediation costs were high, many of you may not be aware that the brokerage for a stock buying or selling was as high as 2.5%. And I'm not talking about the gap, which is called the spread between the buying and the selling, which used to be substantial. Okay. So 2.5% was the maximum cap by the SEBI. And today that has come to maybe 1/10 or 1/15 of a percentage, okay, or 5 or 6 basis points. Okay. And broader access. So it has allowed they say democratization. Today, for example, one is the intermediation part. Second is the digital. Today, fintechs are largely in areas like payments. Banking has changed from going with a check, depositing check, etc. Now today, I have visited a bank. My son, who is in your age bracket, he didn't visit a bank, and he has 4 accounts, okay? And he transacts money, seamlessly between one account to other account. Now that has all been made possible by what you call this so-called, saying not exactly fintech, but I think at one level today you have a KYC which is done e-KYC. Of course, that's not a point of discussion. I think KYC is a part of a bigger rigmarole. We have made a mess of it. From the earlier times, today, for example, when you want to buy a railway ticket, not railway ticket, I mean buy an air ticket, look at the hotels, look at the holidays. You check the internet and find out which is the cheapest. Just want to check with any one of you. Have you ever checked the reliability of the guy who is offering the cheapest? Has anybody tried to figure out the company or the entity is selling you the cheapest holidays are owned, or who are the people, those who are doing it? No? Is it important? As long as I got the ticket, I get the holiday, I'm comfortable or sure that the guy will be, or your people will be there to take care of me in the hotel, etc. Booking will be there. In case it doesn't happen, then what do you do? Call the customer service. It's a fintech. If you look at this industry, has been growing very, very fast. The last, I saw the data was 31% annually. CAGR expected to grow at the same rate for the next almost about 4 or 5 years, if not more. Okay, and then for example, technologies are looking at making the process seamless. You just go log in, pay the money, money goes, then you're on. Okay, make my trip, etc. Ease my trip. Now the number of areas where intermediaries have been bypassed. They are cost efficient. Okay, they are because you are check the 3 hotels, and they are customer centric. That means you are at the center. Can you tailor make your package? Okay, you can do that. Okay, which was not feasible earlier. But largely, fintech was towards the B2C, which is basically wherever the intermediation was there, and you go to the consumer directly. B2B again is limited, and largely they have disintermediated the intermediaries in between, right? So that is the fintech space, in the sense of if you look at digital payments, digital financial services. Is that I was talking to a startup as an advisor. They wanted to go something into the idea starting from bills discounting, that they want to discount the bills of these are commercial bills which are basically raised by companies onto another, the vendors have that, and it'll be traded. And his idea was, let's find this as a pricing mechanism, that you could find the inherent interest rate at which people are willing to lend to that company. Of course, it didn't really take off, but I think because pricing is a different game. Okay. If you are really looking at like lending, that's the reason why, for example, okay, P2P lending. Again, P2P is of course within the NBFC guidelines. We'll talk about that.